We spent basically the last 3 years experiencing the same thing. Starting out slow, but ending things on a positive note, and finally ending up with some positive growth. Just like 2010 and 2011, the first quarter was a little bit scary, a little shaky. We don't anticipate that this year. In 2013, fortunately, we dug out of each one of those years and ended positively. And every year, we've seen a drop in vacancies since back to 2010. Gross absorption is basically the activity in the market. And what we've seen here this year was respectable, 4 million square feet. It's obviously about 1.5 million off of the 3 boom years of 2005, 6, and 7. However, these are pretty positive numbers. You start to see it, and it's more of what we're more experienced and more of a, I guess, sustainable type of activity level. Net absorption, which is the true growth, has similar characteristics. The last 5 years weren't pretty. I think of note is 100% of 2012's activity in net absorption was existing inventory. Whereas in 2011, that 924,000 feet was basically 2 build-to-suits, the Now Foods and the Urban Outfitters. So we're starting to see some of this existing inventory move out of the market. We're still way off from the heydays, 2.9 million feet, but again, we're getting to a balance. Vacancy, this is a pretty dramatic graph, let's just say that. The rising trends of 2006 through 2009 was when frankly, we overbuilt. It was right before the recession. It's now finally tapering off. We've still got a long ways to go. A healthy market is between 8 and 10%. We're at 13.5, but you can see we've dropped over a full point from last year. And I think when you see our forecast, you'll see that things are really starting to trend in a positive way. We're looking forward to 2013. Construction, here's what everybody cares about. Well, in 2012, there was no construction. In fact, that's literally unprecedented. In 2007, you look at the graph, that was committed. Everybody committed to build. 2008, things kind of started to the south. You had to finish up that construction, and it took us quite a while to absorb it. And we're still trying to absorb all of that. And of note again, though, was in 2011, that was 2 build-to-suits really that accounted for all that construction. There's no construction plan again for 2013, but I think you'll see the case in a little bit here that we need to start thinking about some things. Here are the transactions of note from last year. This was 1025 Sandhill, former Pfizer facility. Sold 2 times in the last 13 months. Originally, it was a $33 million investment. These sales at these numbers are bargains. The last sale was driven by the fact that there was a 10-year tenant in tow, and obviously it allowed for the property to be leased way below replacement. This is a kind of a different significant sale, just recently happened right at the end of 2012. Hamilton bought one of Mackenzie's properties on Edison Way. If you look at that comp, it's $71. That's strong, but frankly, it's a little inflated. There was a reason for it. Hamilton has a big investment on Energy Way over there, and they needed to expand, and this was obviously the natural play. So that's a little out of the norm. This was another strong sale. These all occurred in 2012. Not all of them, but these are some of the big ones. This was SIOR converting. Like Sandhill, it was an excellent purchase. Way below replacement. This included also an additional 20 acres of property out right on Stead Boulevard. Also is rail served. Class A facility, probably literally 50 cents or less on the dollar. This kind of gives you an example. This sale over the Quail Business Park on Longley, where it's right on the corner of Miraloma and Longley. A Ribeiro property is distressed, sold at auction. 75% vacant, but it sold at less than half of what it would cost to replace it. It's a good example of a value add deal, and there are still many value add deals out there in the market. Last year, we had some pretty good gross absorption, as you saw. Most of it led by this one lease here, 292, 300,000 feet, out at the Lear Industrial Center, driven by a company called Biz Chair out of Atlanta. This tenant is another internet fulfillment company joining the ranks of Toys R Us, GSI Commerce, Zulily, and Amazon. This is a good market for internet fulfillment, and we expect it to continue. This was another kind of gives an indication of our market, our logistical strategic advantage for our location. Pittsburgh Paint and Glass joins now Sherwin-Williams with a large distribution center here. They've had production now for about 4 years out in the Tahoe Reno Industrial Center. They decided to support it with now running their distribution out of here as well. And it just bodes favorably for our region. This is that lease that drove the 1025 Sandville transaction. Sanofi, who was actually looking to move out of the area, they were in about 30,000 square feet over on Vista Boulevard. They've now taken a large leap of faith, leasing 160,000 square feet for 10 years. They benefited very nicely in being able to move into this facility. It's literally almost turnkey, very specialized, and also another indicator why Reno's a good place to locate. Significant lease also out in Trademark, also bodes well for Reno. The company founded here, grew from 30,000 square feet to 120. Took a long-term lease, fourfold expansion, deciding to commit even after being purchased to staying here in Reno. New to the area, Alpha Acer, I guess you'd call it a high-tech chemical distribution facility. They're going to invest millions of dollars in an existing building over on Briarly. They did also a 10-year commitment, and new to the area, they're coming from the Boston market. Here are the trends that we see. Inquiries are up. You'll see we track everything over 40,000 feet on a very tight basis. That's up about 14 slots up to into the 40s. It got as low as 20. Actual good, legitimate deals in the market looking at industrial. A lot of that's being driven by our friends over in California. What we're seeing is a lot of food grade use. And those make long-term commitments. They need improvements to their building above the norm. And we're also seeing manufacturing. That's where we think a lot of the future is going to be for a lot of the B grade and older, somewhat functionally obsolete products you find in this market. Most of that located in Sparks. Rents have stabilized, we think. The days of giving away deals, I think they're over. We think they're over. They might start to trend up about mid-year. And with that said, we might start talking about going vertical with some property, with some buildings. Sales will remain good through 2013. There are still some great bargains out there, in my opinion. A couple of those, everything is significantly below replacement. So when do we build? Is it time? Well, that's all driven by the rents. We think the rents are going to get there by the end of the year. Some of them, I think, will seriously have plans to come out of the ground. The only way we can go is up. We've been to the bottom. Here's our forecast for 2013. You'll find that it's still a little low, but it's healthy. It's balanced. The construction industry with home building is recovering, and that will start to backfill a lot of these older buildings that vacated in Sparks and those areas over the past 4 years. Lack of A product is definitely going to benefit this B product. There's still great rents to be had in that product, and once that absorbs, I'm going to go vertical. Net absorption of note here is in 2011, that was almost all build-to-suit. In the second year, in 2012, that was all existing product. In 2013, that's still going to be existing product because there aren't going to be any build-to-suits. With that, inventory of that product at the end of the year, we expect to be very low, and all sectors are going to benefit from this. We're way past the 2009 of -1.7, and if you look at these trends, we're getting, for the long term, we're getting back to the normal market. Vacancy. This is a whole point decrease we expect, actually about 1.2%. It's still too high, but these trends are coming down much faster. The sub-markets are driving an analysis of the product classes in the sub-markets. People are then going to decide what they want to build and where they're going to build it. There's a lot of lag time to consider, and this new construction won't be reflected until 2014, and at that point it'll probably still be in the latter half. We're close to the light at the end of the tunnel. We're bullish. It's nice to feel that way. It's been a long run. And if you'd like to get more information, just leave a card up here. We'll put you on a list to give you these reports. Thank you for your time.